It is winter, somewhere near the coast of ancient Greece, and you are standing in an olive grove with no olives on the trees. Everyone in town thinks you are a fool, and you are about to make a fortune off of a harvest that does not exist yet. The man doing this is Thales of Miletus, a philosopher, famous for staring at the sky and falling into wells. The story comes down to us through Aristotle in a book called Politics, written around 2,300 years ago. People kept mocking Thales for being poor. They told him philosophy was useless. So one winter, he looked at the stars, read the weather the way he read everything, and decided the coming olive harvest was going to be enormous. He did not buy olives. He could not. They did not exist yet. So he did something stranger. He went to every owner of an olive press in Miletus and on the island of Chios, and he paid each of them a small deposit. Not to buy the press, just to lock in the right to use it later at a price agreed now. It was the dead of winter. Nobody else wanted the presses. So they took his money and thought they had won. Then the harvest came in, and it was huge, exactly as he had guessed. Suddenly, every farmer in the region needed a press at the same moment, and Thales held the rights to all of them. He rented them out at whatever price he liked, and he walked away rich. That is the whole video, by the way. Everything that happens after this, every trading floor, every nine-figure hedge fund desk, every screen full of green and red numbers, is a footnote to a broke philosopher and some olive presses. My name is ST, and I spend way too much time trying to make sense of the market. If you have ever heard the word options and felt like it was a club with a secret handshake nobody taught you, stick around and subscribe, because the handshake is older than the alphabet you are reading this in. Now read that story again because most people read it wrong. Thales did not get rich because he was right about the olives. Plenty of people are right. He got rich because of the shape of the deal. He put down a small amount of money. If the harvest had failed, he loses the deposits, and that is all. His downside was tiny and known in advance. But his upside, if he was right, was the entire olive economy of two regions at once. Small fixed loss, enormous possible gain, the right to do something later without the obligation to do it. That asymmetry is the entire invention. We just gave it a clumsy name, a call option. The right to buy something later at a price you agree on today. And once you see that shape, you start seeing it everywhere in history, long before anyone drew a chart. You see it in Holland in the 1630s, during the Tulip mania. People think Tulip mania was just rich Dutchmen paying a house price for a flower bulb and going broke. But a lot of that trading was not in bulbs at all. It was in the right to buy bulbs, options. A grower could sell the right to buy his crop at a set price. A buyer could pay a small premium to lock that in. When the whole thing collapsed, and it collapsed hard, options got the blame. So they got banned. Not regulated, banned. After the crash, options were outlawed in pieces of Europe, in Japan, in parts of the early United States. In London, trading them was made illegal from 1733 all the way to 1860. More than a century where the most useful tool in finance was treated like a vice. And I am not going to sell you a conspiracy here because the truth is quieter. The reason options keep getting banned across history is not that some cabal feared them. It is simpler and a little sadder than that. Options let you make a giant bet for a tiny amount of money. That is exactly why Thales loved them, and it is exactly why they scare people. The same leverage that makes you brilliant when you are right makes you radioactive when you are wrong. Every generation rediscovers this, panics, and tries to make the tool illegal instead of admitting they used it badly. Skip forward to America in the late 1800s, and the bans have mostly worn off, and you get a financier named Russell Sage. Sage is a genuinely fascinating character, the kind of man who would charge his own mother interest. He brought options back into American markets in a serious way, trading puts and calls over the counter, meaning privately, one deal at a time. And Sage stumbled onto something the textbooks would not formally write down for another century. He noticed that a call, a put, and the stock itself are all secretly connected, that you can combine them to manufacture one out of the others. Today we call that relationship put-call parity, and it is taught in every derivatives class on Earth. Sage was using it in the 1870s to build synthetic loans and sidestep the laws that capped how much interest he could charge. He was doing financial engineering before there was a name for either word, but notice what all of this has in common. From Thales to the Tulips to Russell Sage. None of it was a market you or I could have walked into. Picture how an option actually worked before the 1970s. You wanted to buy a call on some stock. There was no exchange. So you called a broker who belonged to something called the Put and Call Brokers and Dealers Association. He would go find a person somewhere willing to take the other side of your exact bet. They would write up a custom contract, hand-drawn terms, a specific number of shares, a specific price, a specific date, signed by two specific people. And that piece of paper was a prison. Because it was custom, it was yours, and only yours. If you changed your mind the next day and wanted out, there was almost no one to sell it to. Who wants your weird, specific one-off contract? You were stuck holding it until it expired. There was no easy price, no liquidity. And quietly underneath all of it, a real fear. If the other side of your trade went broke, who was going to pay you? Nobody was standing behind the deal. It was a handshake with a stranger, with money on it. That is the hidden default that ran for thousands of years. The asymmetry Thales discovered was beautiful. The plumbing around it was garbage. Which brings us to a former smoking lounge in Chicago. In the late 60s and early 70s, the Chicago Board of Trade, the place that traded grain futures, was looking for something new. They handed a young man named Joe Sullivan the job of building an options market that actually worked. And the radical idea, the thing that changes everything, was standardization. Instead of a million custom handwritten contracts, you make them all identical. Same contract sizes, a fixed menu of strike prices, a fixed set of expiration dates. Now, my call on a stock is exactly the same as your call on that stock, which means I can sell mine to you in seconds because it is interchangeable. And then they put one more thing in the middle, a central clearinghouse, the Options Clearing Corporation, that stands behind every single trade. So you are no longer trusting a stranger. You are trusting the house. On April 26, 1973, the Chicago Board Options Exchange opened for business. They opened it on the 125th birthday of the Chicago Board of Trade, and they literally put the first trading floor in a converted smoker's lounge because nobody upstairs believed it would amount to much. That first day, they traded options on 16 stocks. The total volume was 911 contracts. 911. Today, the same exchange handles billions a year. And one more detail that tells you how cautious everyone was. On day one, you could only trade calls, the right to buy, puts, the right to sell, the thing you use to bet against a stock or protect yourself in a crash were considered too dangerous. They were not approved for another 4 years until 1977. Now sit with the timing for a second because it still gives me chills. 1 month before that smoking lounge opened, two academics named Fisher Black and Scholes published a paper with a thrillingly boring title, The Pricing of Options and Corporate Liabilities. Inside it was a formula. For the first time in human history, there was a real mathematical answer to the question Thales had to guess at in his olive grove. What is the right to be wrong actually worth today in cash? The exchange to trade options and the math to price options arrived in the same season, by accident after thousands of years of neither. By 1977, traders were walking the Chicago floor, holding calculators with the Black-Scholes formula burned right into the chip. And my favorite footnote in this whole story, Scholes later went to Texas Instruments, whose calculators were running his formula, and asked for some royalties. They told him the formula was public domain, so they owed him nothing. Then he says, they suggested he could at least go buy one of the calculators. He won a Nobel Prize for that formula. He did not get a free calculator. So, when people ask me where options came from, my answer disappoints them. Nobody invented them in 1973. The bet is ancient. A philosopher made it with olive presses before there were banks, before there were stocks, before there was a single share of anything to trade. What got invented in that smoking lounge was not the idea. It was the plumbing, a way to make Thales' bet standard, tradable, and backed by something stronger than a handshake. Strip away the screens and the Greek letters and the billion contract days, and every option ever traded is still that one move. Pay a little now for the right to be right later, and the freedom, if you are wrong, to only be wrong by a little. You are still standing in that winter olive grove. You always have been.